Okay, guys, looks like we got some news today from Bloomberg and Yahoo Finance. The title is Day Trading Restraints to be Loosened under a Proposed Rule Change. And the rule change that they're talking about is the PDT rule. So they're proposing, and they're going to vote on this, to remove the PDT rule. So what do you guys think about that? Do you think it's a good thing or you think it's a bad thing? For me, actually, I think getting rid of the PDT rule will actually be a good thing. I think it will be a good thing, even though it does protect some people from being very irresponsible with their money. But if they're irresponsible with their money, that rule isn't going to stop them from blowing their money. Because the argument in this article is saying like, oh, well, it's not going to stop. The PDT rule is not stopping people from taking risky bets. What's happening is that when the people, let's say beginner traders, are done with their 3 trades a week and they hit the limit for equities, buying and selling 3 times a week in a rolling 5-day period, that's the PDT rule. Again, I can review this. Yeah, if you don't have 25K in your account and it's a margin account, you can only trade 3 times within a rolling 5-day period until you have a balance over 25,000. If you have a balance over 25,000, you can trade freely as much as you want with no restrictions with settlement margin and actual margin if you want to use actual margin. But under 25K, you're limited unless you're in a cash account. But if you're in a cash account, you can only trade up to the value of your cash balance in your account of cumulative trades on that specific day. So back to the argument is they were saying that the PDT rule is not stopping irresponsible people from taking risky bets. After they're done with their 3 trades for the week, they're jumping over to futures. They're jumping over to another broker. They're trading options. They're taking risky meme stock bets. So the PDT rule, they're arguing that it's not actually protecting people. Actually, in a way, it's pushing people to more riskier assets. And another thing is, in my opinion, when I was under the PDT rule, I remember in the early days of my trading 3 times within a rolling 5-day period, I remember being like, I only have 3 trades. I have 3 trades. I can't mess this up. I can't mess up this trade. And so what happens is that I'm holding on to the trade for dear life, and it's just going lower and lower and lower and lower, and before you know it, turns into a swing trade, and before you know it, I own a portion of some crappy, no-name penny stock that is going to 0.0001 cents a share. And that's happened to me. I bought a stock at $3, and I didn't want to sell because it was my last trade of the week, and I was like, this has to be a green trade. This has to be a green trade. Ended up holding it all the way down to where it got delisted off the exchange. It got delisted off the exchange, and I got sold out for 20 cents a share. That takes the cake for my worst ever trade ever that turned into a swing trade, into some investments, now a long-term holder into some crap penny stock that I had no idea what the hell this company does. And so that's what the PDT rule did to me, was it got me attached to the trade. So that's one big reason why I don't like the PDT rule, because it gets you attached to the trade. It makes you think, oh man, I got 3 trades, like they have to be green, they have to work out. And now you're struggling to cut the loss. But when you don't have the PDT rule, you're buying and selling freely. You're like, hey man, if this ain't going up, like I want to sell this right now. Like, I am not going to hold on to this and hope. There's no reason to hold and hope. I'm cutting the loss and moving the heck on. So that's the mindset that you can adopt when you do have that feeling of, oh, I can trade as much as I want. It's not necessarily a bad thing to trade as much as you want. It can turn into a bad thing when you start over trading. And when you're over trading, you're seeing trades that aren't actually there. And you're kind of just on that dopamine addiction. You're sitting at the desk on that dopamine addiction, hitting buying, sell all day on low volume, really crappy tickers, no news, has wide spreads. You're just like you're just trading just to trade. You know, you're not even taking good setups. You're not trading in the right time of day. You don't really know what you're looking for. You're just trying to buy and sell and hope that you're green. So that's not what I'm talking about. That is just a discipline issue. And you know, I think, you know, you gotta, if you get into day trading and you're taking it seriously, like you gotta, I feel like you have to learn the hard way. You know, you have to learn the hard way, like with trading. It's like you got to burn your hand on the stove a couple times. That's the only way you're going to succeed. And this rule, I guess, is they're trying to prevent beginner traders from burning their hand on the stove. Which, here's why originally, it says in the article, why originally the rule came into place. So the existing rule, adopted in 2001, if you guys know, remember, 2001, that's 1 year after the dot-com bubble, was put in place to protect investors from massive losses and borrowing more than they can cover in holdings or cash, which is exactly what happened a year before this rule came into place. Massive people, lots and lots of people were taking out massive loans and margin, borrowing against their assets, their portfolio, just to buy more and more of these dot-com tech stocks going to the moon, buying every dip in perpetuity until the stock hits infinity, which eventually crashed and burned and everyone lost a lot of money. Yeah, it makes sense why this rule came into effect. And so another one of their arguments is saying, oh, well, now the market's changed. You know, the average retail trader has access to almost, I'm not going to say everything, because we don't, almost as much information as the people on Wall Street have. We still have access to the news. We have access to scanners. We have access to all these resources. We don't have access to a lot of the dark pools. I think you can get access if you have the right broker to the dark pools. I think there's a couple traders out there who said they do have access to dark pools and I'm sure, honestly, Wall Street has like some insider knowledge on a lot of these trades. So that's why I said almost, but we definitely have a lot more information now than we did in 2001, which I wasn't trading in 2001. I was like 5 years old, but I wouldn't know from experience. But in 2001, what I hear was like, yeah, we don't, like, the stocks wouldn't even move until like 3 hours after the news dropped, because nobody had any idea there was news on it yet, because like the news was so late. You know, like the internet was so slow still. It wasn't real time. And I'm sure a lot of the trades were over the phone in 2001. I think, yeah, most of the trades are probably still over the phone in 2001. So the average trader was still relying on like an actual person on the other line to fill their order and give them information. And I'm sure the quotes were not real time online. If you were trading online, I'm sure the quotes were definitely not real time. You're definitely not getting the tape. You're not getting depth of market. You're probably just seeing a line on the screen and maybe a news site, maybe a scanner, maybe a shitty scanner. But yeah, the access to information we have now, their argument is saying like, we have access to a lot more information. We can make more informed decisions and less risky decisions. So it's not necessary that we do need a PDT. And also, since everything is commission free, we're taking a little bit less risk as far as from over trading, because over trading will add up with your commissions. And so the PDT rule would have restricted your commissions from adding up too much, because you're only taking 3 trades per 5 days. So that's another reason. And it's kind of interesting. I mean, it kind of makes sense that a lot of the Robinhood, like payment for order flow brokers, I think the CEO of Webull chimed in somewhere in here, and Robinhood is also on their side, and a lot of the payment for order flow brokers are on their side because they make money from active traders. So they make money from selling data from people trading many orders. The payment for order flow. They're getting paid from the market maker, selling the customers or the retail traders data and order information to the market maker. And so that's how they make money. So they will benefit. They will benefit from the PDT rule going away. So that's another reason why I think it's going to go away, because of the push from these payment for order flow brokers. I don't think payment for order flow is going to go away. I think there was sort of a contest, it was sort of contested a couple years ago. I remember payment for order flow, but it stuck. So I think it's here to stay. I don't think it's going to go away. But then another argument from the people who are for PDT were saying like, oh, well, Robinhood was criticized for doing meme stocks or gamifying investing, because now gamifying is making it seem like there's no consequences for your actions, and it's more of like a fun thing to do, and it kind of enables like dopamine addiction when it comes to trading. But it looks like they said they have since sought to rebrand and target risk-averse customers alongside their other clients. So, yeah, I don't. Some brokers retail now see the PDT rule as an antiquated relic. The PDT rule is an antiquated relic of the dot-com bubble, when greater protections were deemed necessary to mitigate risk. So, pretty much what we just talked about. Some of these risks involve high trading costs and lack of customer oversight by brokerages, more of an issue when monitoring software was less sophisticated. So yeah, right now we have access to much more sophisticated trading platforms. We have access to getting in and out of the market within seconds, within less than a second, something that we did not have in 2001. So yeah, here comes to like the changing times is like one of the arguments. So zero commission fees, lowering costs, easing financial risks, no commissions. I'll put the link to this article if you want to read through this in the description. So from Reddit forum, so people were complaining that the $25,000 minimum is arbitrary, making traders over-allocate capital to their accounts to an extent detrimental to savings. So what they're talking about here is people were just funding their account with $25,000, even if that's everything that they had in their savings account. And I was one of those people. I was working a job. I was serving tables, waiting tables, saving up for $25K. And as soon as I had that $25K, I transferred everything into my brokerage account so I can trade as much as I wanted to over the PDT rule, which only left me a couple $100. I remember only a couple $100 in my checking account. And I was like, fuck yeah, I am going to survive on a couple $100 because I am going to trade my way out of this. And that's how I began trading. So yeah, that's one of their arguments here on Reddit, is saying it's kind of arbitrary. And now people are just over-allocating capital to their accounts, and it's detrimental to their savings, and posing a barrier for those seen as not wealthy or intelligent enough to trade equity derivatives. Clients can also open up additional margin accounts at multiple brokerages to work around the rule, which was a thing. You can open up multiple brokerages, leading brokerages to view it as ineffective. So yeah, it can be ineffective if you are opening up multiple brokerages. So that's one reason that's kind of like, well, it's not really, people can still get around it, So yeah, people, all in all, Mark Phillips, the founder and principal of Reading, Connecticut-based Harvested Financial. Never heard of that. Some financial advisory firm that specializes in options trading. It's kind of a silly rule that gets in the way of freely functioning markets. And he's kind of right. If America is a land of the freely functioning markets, the PDT rule is against that ideology. So it kind of, I think in a way it does work against us. So what do you guys think here in the comments? Let me know. And yeah, I'm curious to hear your thoughts. And if you enjoyed this little article, hit the like, subscribe, and I'll catch you guys later. All right, peace.